Hey, Jason Rogers here, and good news, we just received a term sheet for the financing that we are intending to complete for the deal we've been looking at in Tampa, Florida. We've looked at a number of deals this year. This one finally had a very clean due diligence period. We're proceeding. We're excited to proceed. I should be receiving 2 or 3 more term sheets in the next week, the next 5 business days. But I wanted to show you one example. Now, here's the things we like about the term sheet that follows. 1, it's a 25-year term, 25-year fully amortizing term. We really like that. That's great money. Secondly, we like that it has a fairly low equity injection requirement. It's just above the base 5%. I think they're asking for about 6% of the capital stack in cash. So obviously liquidity, greenbacks, that is the most expensive form of capital. So the less we have to put in the capital stack, the happier we are. So the fact that they really crafted this to have a low equity requirement, we're really happy about that. However, because we're not putting as much money in, they are not right now looking to provide as much working capital. I'm gonna have to negotiate that. We're seeking $350,000 worth of working capital. And equally, this does not come with a line of credit. We have other lenders we're talking to where we fully expect we have verbal agreement that we will also be receiving a line of credit and a much larger amount of working capital. And ostensibly also a 25-year AM. So if we can get the 25-year AM, a lot of working capital, and a line of credit, we're very happy. Now, with these 25-year notes, everything I've seen so far with the SBA is that they are on a variable interest rate. So that's entrepreneurship. But at the end of the day, if you've been following the Fed, if you've been following interest rates, if you've been really paying attention, you probably also feel, like I very strongly feel, that we're going to be in an inflationary period for a long time, and the Feds aren't really going to be able to start cranking up interest rates and treasury rates too quickly. We think it's going to be down real low for quite some time. So I'm excited about that. We're excited about that. Let me get into the term sheet here, and then we're going to talk a bit more about this 25-year note. Hey, it's Jason Rogers. Thank you so much for watching the video. Be sure to subscribe, thumbs up the video, and for more, go to jasonpaulrogers.com. Quick update before we get into the main part of the video. We made a $2.3 million offer about 2 weeks ago. We went through diligence, we found problems, we pulled out. We parlayed it last weekend into a $2.4 million offer. We think and hope and some would expect that this deal will be accepted, or that a slightly changed variant of the offer will be accepted. And if it does get accepted, I want to describe to you how we intend to finance the acquisition using a very, very interesting play from the SBA. Hey, it's Jason Rogers here, and in this video I quickly want to talk about how we intend to procure about 85% leverage on a 25-year AM to procure both a business and its real estate. Pretty simply put, this is going to be the 504 program through the SBA, which allows you to acquire companies and or real estate. You have to have them together on a 25-year amortization schedule at a quite low interest rate. Now, let me be fully transparent. We're in the process of making this happen right now, so I can report back later with the details and the skinny. But at the very minute, we do fully intend to lock in a 25-year AM to buy a business with its real estate. And for those of you who know finance, you know that a 25-year amortization schedule is just very difficult to procure if you're working with traditional commercial lenders, or if you're working really with any other lender. But because this is an SBA program with the government behind it, they are able to do things that otherwise you would not be able to procure on the open financial market, at least if you don't have a ton of net worth and a lot of bargaining chips, right? This is not advice for someone who has $46 million in net worth. You're probably not watching this video if you have $46 million worth of net worth. And look, I don't have $46 million of net worth. And that's the point. That's why this is powerful, because for, let's just say, individuals with a slightly more normal financial background, this is very, very cheap capital that you can use with high leverage to acquire businesses and real estate. And especially when you structure the deal at 2 to 3 times EBIT, 2 to 3 times earnings before interest and taxes, it really makes this thing work. Now, here's the key. You need the real estate to be more valuable than the business acquisition. This is a mandatory piece of structuring the finance to be able to procure this 25-year AM. If you're familiar with the SBA 7A program, you know that traditional business acquisitions are put on a 10-year fully amortizing note.
And of course, that's going to cut into your debt service coverage ratio. That is going to cut into your free cash flow. But when you have the real estate that accounts for 50.1% of the financed capital stack, not the total capital stack, but of the leverage itself, if you're applying 50.1% of the leverage to the real estate, as we understand it, and as our bankers have explained to us, you're able to get this thing through. And again, if the debt service coverage ratio is high at over 200%, ostensibly because you're buying the business itself for 2 to 3 times EBIT, and then you're buying the real estate at fair market value, what you really have now is a collateralizable asset that really makes this thing no problem to get financed. Because here's the other thing about the SBA. The SBA gets a 75% insurance policy for all intents and purposes. They wouldn't deem it as an insurance policy, but that's essentially what it is. The SBA, the government, I should just say, to be blunt, backs 75% of SBA proceeds. So the commercial lender you work with that's working through the SBA, they're backed for 75% of the money they put into the marketplace. That means they really only have 25% of their debt that's needing another form of collateralization. And so when you then throw in real estate to a business acquisition, and if that real estate happens to be of a higher total value than the leverage you're using to buy the business, then you have a wonderful position wherein the government's going to back 75% of the finance, and then the real estate is already collateralizing ostensibly 50% of the leverage, and so you have well over 100% collateralization of the finance that you're seeking, which means any lender that can't give you this kind of finance, well, really, it's usually then going to be a reason looking at you, the procurer of the finance. But I mean, realistically, as long as you can speak intelligently, as long as you have a strong business plan, as long as the business looks primed to be successful, this should be no problem to get financed, because the SBA ensures that the lender that's providing you this finance is totally collateralized with their 75% guarantee combined with the real estate. So again, really then it just becomes a free cash flow question, right? The loan is collateralized. And really, let's talk about finance for a second. I mean, in my estimation, you disagree, share in the comments below if you disagree, but there's really only 2 things lenders are ever looking for: collateral and cash flow. And that's it. I mean, what else is there? There's collateral, hard assets that they, being the bank, can liquidate if things go wrong, which of course no lender ever wants, but they have to prepare for the worst. And then there's cash flow. Your personal cash flow from income sources you have, the business's cash flow, the rent from the real estate, whatever it is, and whatever you have as the person procuring the finance, whatever cash flow you can conjure up and put together, that's the cash flow that the lender is going to be betting on for you to repay the loan, for you to repay the note. So this is finance in a nutshell. And as long as you can then sell the free cash flow side, because again, the deal is collateralized with this 25-year RAM, the 504 SBA program, as long as you can prove the cash flow is there, and as long as you can make sure the cash flow is going to be there in the future, getting this kind of finance is relatively easy. And again, that 25-year RAM at a quite low interest rate, we're looking at maybe 3.5% to 4% is what we expect. We hope. I mean, we'd be very happy if we'd be able to procure real estate and a business at 4% or lower. That would be lovely finance for us. And it really, when you're using 85 or 90% of the capital stack on a 25-year AM at 4%, you see what you can do for yourself. So again, we're very excited, and we really recommend for you, if you're out there looking to buy businesses, small businesses combined with real estate, you consider this strategy. And if you're an investor that doesn't want to do all the hard work of picking up the phone and making all these outbound calls to find deals, well, you can also invest with us. With that, I'll let you go. You have a great afternoon or a great day. Take care.
Hey, it's Jason Rogers. Thank you so much for watching the video. Be sure to subscribe, thumbs up the video, and for more, go to jasonpaulrogers.com.